So the second video about free cash flow to firm method, okay? So you can estimate FCFF of your firm in the past. Also, you can estimate the free cash flow to firm in the future with some additional assumptions, right? Well, for the past, right, just need EBIT, operating income, tax rate, and then capital expenditure, depreciation and amortization, and non-cash working capital from the financial statements in the past. Once you have those items, I already gave you all these items about thousands of different companies in the US and in Korea. So just you can work it out in your, yourself, right? You can statistically test the patterns of those things actually. I gave you the playground, by the way. Anyway, so FCFF example. Well, here is my example about SK Hynix in 2016. And then EBIT at that time, right, turned out to be 3.3 trillion Korean won. And then marginal tax rate 24.2%, and depreciation and amortization 4.4 trillion Korean won. I got it from the cash flow statement. And then capex, right, 6.3 trillion Korean won. And then non-cash working capital is the item that you have to worry about. Remember at least the three items, right? AR, inventory, AP, okay? AR plus inventory minus AP is the thing, right? The key item is about inventory. How much chip inventory do you have? No inventory, no sales. So you need to build up something there. That's the idea. Okay, so based on 2 years data, you need to calculate the change in non-cash working capital, which means for each year you have to calculate the non-cash working capital, right? So what do you have to do? Year by year, AR plus inventory minus AP, you have to calculate the non-cash working capital. And do the same for the next year, 2016, and then get the change, okay? And that will be the amount for 2016. What is the free cash flow to firm based on these calculations? Well, the next page, I show you my calculation, 3.76 non-cash working capital balance at the end of 2015. 2016, it increased to 4.58 trillion Korean won, which means overall the working capital, the inventory increased, okay? As you see, and then accounts receivable increased. That means it was draining your cash, okay? More stuff got stuck on your shelf, and then accounts receivable increased, which means you did not receive cash as much as before, right? So more cash was held on by the clients, right? Also, your accounts payable decreased, which means you repaid your payables to your suppliers. So suppliers took more cash from you, okay? So in all respects, it was draining your cash. So net non-cash working capital increased, and then changing non-cash working capital plus 0.82 trillion Korean won. It was draining your cash, free cash, right? So what's the consequence? And then how much is your free cash flow to firm? Well, you start with EBIT times 1 minus tax rate, and then subtract the reinvestment. The first part of your reinvestment is your net capex, which is capex minus depreciation. And then the second is about your change in non-cash working capital. That's the short-term investment. So adding those two should be subtracted from your after-tax operating income. Easy, right? So that's how you get minus 0.294 trillion Korean won. Okay, that's the answer, numerical answer, but what's the idea? You got minus free cash flow to firm, okay? And then if you draw time series graph of free cash flow to firm for SK Hynix over its using the data, okay, starting from 1989 and up until 2016, the time series graph looks like this. Very volatile, fluctuating like crazy, right? You can see that. And the recent number was slightly negative, okay? Minus 0.29 trillion, okay, almost 0.3 trillion Korean won minus, which was below this excess over here. And what does this mean? Well, it means that the company has to either borrow money from the creditor or issue more equity. Okay, so you are running, down your cash. So that's why you need to borrow more or issue equity. Okay, to finance your projects or your businesses. Okay. Number two, volatility of free cash flow to firm is one thing to notice. Okay. Sometimes it's deeply negative, sometimes it's highly positive. Why do we have such a dancing free cash flow? Okay, because of the nature of the business. Remember, this is SK Hynix. Okay, semiconductor super cycle matters here. Okay, memory chip business, right? Memory chip business. This is commodity. Okay, this is 상품 시장. Commodity is just like rice, wheat, or the crude oil kind of business. Each product, okay, what they produce is just identical small semiconductor chips. Very, very identical, which means there's no unique feature. Each different product, they are the same anyway. It's easily replaceable. Okay, commodities, okay, 상품 시장. So the property of this commodities market is that just 1 percentage point mismatch in demand and supply results in drastic price change of your product. Okay, if you're lucky and then the market demands a slightly more than what you produced, and then the commodity price in the market skyrockets like crazy. And that's precisely what we are experiencing as of 2026. The semiconductor super cycle. I was almost to say 반도체 super cycle. 반도체 super cycle, right? So that's what you're experiencing. Like this, a huge plus, right? How about negative side? Well, if you got unlucky, so much so that you produced slightly more than just 1 percentage more than is demanded in the market, okay, then drastically your price of the chips or the commodities will plunge like crazy, and then you will be in the toilet. Okay, you go to toilet, diarrhea time. Okay, so that's drastic volatility that you will experience as you do semiconductor industry. What's the implication for Korean industry as a whole? Okay, the country-wise, because Korea is the Republic of Semiconductor. This is our breadwinner business, right? Especially memory chip, right? Notice that our business nature is really volatile and very risky business. Okay, so the fact that we are experiencing super cycle in positive side does not mean that we will live and party forever. Get ready, soon you will experience a downturn. Okay, you need to have some precautionary savings, okay, to prepare for that. But at the same time, you have to find out a way to diversify your business. Don't get concentrated. Don't put all your eggs in one basket called semiconductor. Okay, so is there any company that diversified away, starting from semiconductor, but reaching out to different industries? Well, Samsung Electronics is the one. Okay, Samsung Electronics, well, they have cell phone business and consumer electronics business and telecommunications equipment businesses, right? Other than semiconductor. So their cash flow is, volatile, but they have some more stable ground. Okay, and then to put everything. You see this. This is a million Korean won unit. Okay, million Korean won unit. So it means 20 trillion Korean won free cash flow at this point. Very good super cycle of semiconductor. But there are some down cycles. Okay, they have to suffer. but they don't go down too much miserably. They don't go to negative area too much, right? Why? Because their business is more diversified. They can sustain it, okay? Whereas SK Hynix is just a single division memory chip business. So they have no way to diversify. They are just facing the cycle of commodities market, semiconductor commodities market to the full, okay? Pure play memory chip semiconductor business looks like this, free cash flow, very, very volatile. But if you diversify, this is your benefit. And if you put both companies in the same perspective, okay, to make a fair comparison, how volatile is it? How risky is it? Well, SK Hynix looked a lot more volatile in this graph, but as it turns out, the magnitude itself is not that much terrible, because Samsung was also suffering kind of negative cash flow in this period, the IMF crisis or financial crisis period, 1997, or some other down cycles like this. But upcycle SK Hynix was is not as much comparable to Samsung Electronics, right? That's something to notice. Anyway, FCFF, okay, that's the path to get some idea about the nature of your business, day-to-day business. You also can estimate free cash flow to firm of your firm, a company, for the future with some assumptions about expected growth rate of EBIT and then expected reinvestment rate. Okay. Reinvestment over here, what is that about? Also, again, it's about net capex and the change in non-cash working capital. And reinvestment rate or reinvestment schedule, etc. You need some assumption to do the valuation going into the future. And then it depends on your growth assumptions, and it heavily depends on your imaginative story about the future. Okay. There you need a lot more creativity than you usually think. Okay, now expected EBIT growth rate. Well, what kind of growth rate? Okay, how can we assume the growth rate? Actually, this is just one of many different ways of assuming growth. It's based on fundamentals here. The other growth projections, you can be more creative, okay? But this is the more solid way of assuming your growth rate based on fundamentals. What do you mean fundamentals? It's about ROC, it's about reinvestment. The story is your growth comes from your ROC return and how much you reinvest, okay? Those two are the sources of your growth, okay? How much do you reinvest, and out of those reinvestment, how much return that you generate, okay? Does this seem familiar? Yeah, it should ring your bell, because we did similar computation and then similar mechanisms we assumed when we were doing FCFE method. There in FCFE, we played with ROE instead of ROC, and then equity reinvestment rate was used over here instead of reinvestment rate, total reinvestment over here. Why is the difference? Because here we have to consider not only equity holders, but also the debt holders as well. So it's more general over here. Okay, earnings growth rate, conceptually, growth rate of earnings depends on how much you reinvest and how much return you generate from that reinvestment. So the growth rate should be nothing but the multiplication of these two, reinvestment rate and the percentage of return. So when it comes to FCFF context, it should be growth rate of EBIT 1 minus tax rate, and then that has to be reinvestment rate times ROC. If the context is about dividend discount model or equity, the FCFE model, then it has to be retention rate times ROE. Okay, you see the parallel going on. Okay, and then expected growth rate in EBIT or net income, depending on the context. Okay, for a company cannot exceed ROC or ROE in the long term. That's the idea. Why is that the case? Because your retention rate or reinvestment rate cannot exceed 1. Okay, so it has to be kept below this ROC and ROE, your growth rate cannot be bigger than that. That's the idea in the long run, okay? Okay, having said that, what's the mathematical derivation of growth rate when percentage return is stable? Of course, in the textbook, they talk about, when the rate of return changes, okay, then your growth rate will be temporarily shocked, okay, and then we will stabilize over the long run. But I'm afraid we don't have time to cover that part in this semester. So just simple model, okay, will take you a long way. So here, when return is stable, how can we compute or estimate the growth rate? Here we go. Invested capital, we have to define this thing first. The invested capital is just a summation of book value of debt and book value of equity. Oh, isn't that asset? Yes and no. Okay, it's different from assets, book value of assets, in the sense that we only care about the interest-bearing debt over here. Interest-bearing debt. Remember, in your balance sheet, the credit side, you had liabilities. Okay, liabilities, you have different groups of liabilities, different categories under liabilities. Not just the short-term versus long-term. I'm talking about interest-bearing debt part versus non-interest-bearing liabilities part, okay? Debt has to do with financing activity, borrowing from the bank or borrowing from the bondholders or commercial paper holders, okay? How you raise capital to fund your business. For SK Hynix context, right? SK Hynix, to finance, to bring money, to build their factories and buy the machineries, they need to borrow from the bank. That's bank debt. Or they need to borrow from the bondholders. That's, bond, which is, more security kind of forms of debt. Whereas bank debt is more private transaction, private contract between SK Hynix and each bank, right? Anyway, another form of funded debt or interest-bearing debt is commercial paper, 약속금 kind of things, IOU. That's much more short-term, 90 days or kind of things, right? Those things are related to financing activities, how to fund your project, okay? What about the rest of the part of your liabilities? For example, deferred tax liabilities, right? That's not related to your financing part. It's just a accounting recognition about how much you owe and you are supposed to pay the government in the future, okay? As it turns out, taxation is time consuming. It's not like, oh, you have to pay the tax, the event happened today, so that you have to pay tax just this year. No, it is, recognized over different time period, and you have to pay taxes over different time periods. So deferred tax liabilities, right? That has nothing to do with your factory building to do your project. No, it's just a recognition and bookkeeping wise. Also, on other parts of liabilities, accounts payable. It's not financing part for your factory building. Accounts payable is recognized in the form of working capital in our computation. So you need to take that out in this debt computation over here. Otherwise, you will be double counting in your computation and it's going to screw up. So take out that accounts payable over here. Instead, notes payable has to be included over here. Notes payable versus accounts payable, aren't they the same thing? The terminology payable is there? No. Notes payable is commercial paper, IOU. You write a note, IOU, okay? So that's why it is called a notes payable. 90 days due, you have to pay it, okay? You just borrow short term from the money market, okay? Money market. 자금 시장에서 짧게 빌렸어요. That's notes payable. Okay? Accounts payable is the credit that you owe to your suppliers to buy some inventories, you sell your stuff in the shelf. Okay? That's different. Okay? Accounts payable, working capital, notes payable, debt. So those distinctions, please make it. I can build a multiple choice question out of it, right? In your exam. Anyway, so that's book value of debt and add it to book value of equity. That's going to be your invested capital. Okay? So that is invested capital is going to be your denominator in computing ROC, return on capital. Remember, this is how much you generate the return based on your invested capital. Okay? Who are those investors? Well, debt holders and equity holders. For these two kinds of investors, how much did you generate as a return? That's the concept of ROC. In that respect, again, your accounts payable has to be eliminated. You should not care about it because accounts payable is not for the investors, but for the suppliers. Okay? So that, make a distinction, please. And then that beginning balance of your invested capital, should be your denominator. And then the numerator has to be after-tax operating income over your current period. Okay? Then growth rate of EBIT should be what? Well, after-tax operating income of this period minus after-tax operating income of last period over the same thing, last period's operating income after tax. Well, just simplify. One balance tax rate is just assumed to be the same marginal tax rate anyway. So they will cancel those things, and then you will get this relation over here. And then we are trying to get to growth rate of EBIT. Okay, there. How do we get there? Well, growth rate of EBIT. Growth rate of EBIT should be EBIT minus EBIT, period by period, in after-tax sense. And then remember, each time the EBIT should be what? Invested capital in the beginning of the period times ROC of this period, right? This comes from over here, the second line over here. And then do the same for the next period. And then one thing to notice is that your invested capital in the T-1 period should be invested capital T-2 period, previous period invested capital balance, plus change in invested capital, right? The invested capital must have changed over T-1 period. And then ROC, the same thing over here. And here we bring one more assumption. Okay, let's simplify it. Okay, let's see ROC being the same. Okay, so that we will be able to cancel out in our mathematical operation over here. So the growth rate of EBIT should be defined as this guy. Okay, EBIT minus EBIT before and divided by EBIT before, and replace this EBIT with these formulas over here. Invested capital, ROC T-1, the same thing, and over here, this guy, IC plus change in IC times ROC. And notice that we assumed the ROC should be the same regardless of the period. So they cancel each other out, and then we will end up with IC T-2 plus change in IC T-1 minus IC T-2, and then these two will be canceling each other out, and then the denominator will be just IC T-2. So in the end, the growth rate of EBIT should be change in IC over IC, okay? And then invested capital, here we do one more mathematical manipulation, operation. Mathematicians' favorite technique. Whenever you see a ratio, split those two and then multiply and divide by the same number. So here in this case, just multiply and divide by after-tax operating income of t minus 1. Okay, they have to be the same, otherwise you will screw up the math. Then the first item, you will realize, oh, that's none other than reinvestment rate. The second item is none other than ROC. And what's the intuition? We confirm that your growth rate of EBIT should be reinvestment rate times ROC. Your growth fundamentally comes from whatever you reinvest and whatever return that you generate out of that reinvestment. Make sense? So that's it. Then the next video, we are going to talk about the further into the expected EBIT growth rate argument. So thanks for watching. See you.